let's dive into something that trips up so many investors, the idea of value. A lot of people think that finding a killer investment is as easy as spotting a stock with a low price. But, as we're about to see, that kind of thinking is a really dangerous oversimplification. So let's just get right to it. Here's the big question. Is a cheap stock always a good stock? And the answer is a huge, resounding no, not even close. And understanding why, well, that's the key to unlocking real, lasting value in your portfolio. And this really gets to the heart of it all. It's about the fundamental mistake so many people make, confusing the price of a stock with its actual value. If you take one thing away from this, let it be this. In the world of investing, cheap should never, ever be confused with good. Your goal isn't just to buy a stock for less than it cost a week ago. Your real goal is to buy a piece of a business for less than it's actually worth. This brings us to a super important concept, intrinsic worth. What is that? Well, think of it as the true, honest-to-goodness value of a company. It's what the business is really worth based on its assets, its earnings, its future, and it has almost nothing to do with the wild up and down roller coaster of its daily stock price. And this is why it's such a game changer. When you can buy something for less than its intrinsic worth, you get two massive benefits. First, you're creating potential for profit, right? Because you're betting that eventually the price will catch up to its true value. And second, and this is so crucial, you build in what's called a margin of safety. It's like a buffer, a safety net that protects you if, your analysis wasn't absolutely perfect. Okay, so how do you actually do this in the real world? It all boils down to the core discipline of being a true investor. You have to learn to see what everyone else misses by focusing on the business, not the noise. Warren Buffett just nailed this whole idea with one simple line. Price is what you pay, value is what you get. The price? That's just a number blinking on your screen. The value? That's the real, tangible business you're getting for your money. They are two totally different things. And you can see how this plays out. The value approach is logical. You're buying a solid, healthy company that happens to be on sale. That automatically improves your risk versus your reward. The speculative approach, on the other hand, is all about emotion. It's about chasing the popular, overhyped stocks where you're basically just paying for pure hope and optimism that might never actually happen. So the takeaway here is pretty clear. The number one discipline you have to develop is the ability to build a mental wall between the daily stock quote and the actual economic reality of the business. That, right there, is the entire game. Okay, so buying cheap sounds pretty good. But, and this is a big but, there is a huge catch here, and it's something that trips up so many investors. You have to understand that sometimes cheap isn't a bargain. It's a warning sign. Which naturally leads you to wonder, right? Are all of these stocks with beaten down prices just hidden gems waiting to be found? And unfortunately, no. A lot of them are cheap for a very, very good reason. This is what we call a value trap. It's a company that looks like a bargain on the surface, but it's trading at that low price because the business itself is in serious trouble. It's not a deal, it's a trap waiting to spring. And here's how you tell the difference. A true bargain is a great, financially healthy company that's just been temporarily misunderstood by the market. A value trap, though, is a company in a long-term decline. Its business is getting worse, not better, and it's probably racking up debt. Your job is to be the detective who can tell which is which. So how do you do that? How do you systematically find the real bargains and avoid all those traps? Well, that brings us to the final piece of the puzzle. Building a repeatable process you can rely on. Let's just state our mission one more time, because it is that important. Your job is not to find cheap companies. Your job is to find high-quality companies that are just temporarily on sale and tell them apart from the ones that are headed for the exits. And here's a framework to help you do it, a 5-step process. First, you identify stocks that look like they might be undervalued. Then, step 2, and this is the most important one, you confirm the company's fundamental strength. You have to dig in. Are they making money? Is the business healthy? This is how you avoid those value traps. Then, steps 3 and 4 are about timing and getting a final check. You can use charts to find a good entry point, and you can check the overall market mood. And finally, step 5. Once all the boxes are checked, you go from just an idea to making a disciplined investment. It's about having a plan, not just acting on a hunch. And that leaves us with one last thing to think about. A process like this can definitely help you find value, but the real challenge? that often happens inside your own head. So I'll leave you with this question. What's really harder, finding that great undervalued opportunity or having the psychological discipline to actually act on it and ignore all the noise? Something to chew on. Thanks for watching.